Let's now connect with Mr. Sunil Duggal, Chief Executive Officer with Dabur India. Sunil, good morning. Thank you for joining us. Construct the business environment for us. The company is growing. Commodity prices are clearly a problem for any FMCG company, and competition has intensified. How have things moved for Dabur for the quarter gone by?
I think it's been a pretty steady performance. The demand side remains robust, so there's no attrition on that front. And as far as margins concerned, we have been able to mitigate the impact through price increases. So we have actually seen margin improvements happening despite significant heightened A&P spends. So overall, it's been a fairly decent few months, which behind us at least.
Are you confident of maintaining a double-digit growth for your domestic business? Because that's what you indicated to us last time when we interacted with you.
Yeah, I think around a 10% volume growth is something which we can realistically look at, and definitely is achievable. We'll seek to grow beyond that, but that depends upon the environment. The demand side, like I said, remains reasonably robust, but it's not very buoyant at this point in time.
Sunil, in particular, how did the festive season pan out for you in terms of growth as compared to last year?
Well, the festive season does nothing extraordinary for us. I think the only SKU which really takes off in the festive season is our Diwali gift packs for our beverages, etc., which had a very good year, of course. But overall, in terms of business for FMCG as a whole, the festive season has very little impact. Like I said, there are pockets of high growths which happen during the season, like the festive packs of beverages as well as the FEM portfolio, both of them which did extremely well during the festive season.
Sunil, analysts have been a little concerned about lower sales growth when it comes to your hair oil segment. Tell us what kind of growth levels are you foreseeing for this particular segment for FY14?
See, the perfumed hair oil segment, which is our mainstay, we are seeing double-digit growths as far as volumes are concerned, and on top of fairly reasonable price increases. So I think overall the traction in terms of hair oils is very good. It's much ahead of what we've seen in the last few years. So we are not at all concerned, if there is some level of disruptive competition on the back of extremely low prices. That's something which we have to live with. But overall, the trajectory of our brand, particularly our flagship Amla hair oil, is very strong, and there's nothing to get concerned about.
So what exactly has worked for you and what is not working for you? When I say that, when I ask you this broader question, I'm talking about key categories. Which categories are growing, which categories are not growing, and what is the response to new launches?
Well, all categories are growing. There's not a single degrowth, apart from some very minor digestive brands which are growing which are not growing because of very high price increases. But that's an aberration. 95% of our portfolio is recording strong growth. Much of it is recording double-digit growth. So it's been a pretty good year as far as the domestic business is concerned. Certainly the volume growths are much ahead of what we saw last fiscal, and that's something to be pretty satisfied about.
Are you growing?
And I think one of the key drivers of this growth, let me just complete, is actually heightened A&P spends, which have really worked for us. So we've spent ahead of the curve in terms of advertising, and that's yielded results in terms of higher growths.
In terms of a mix, is the semi-urban market growing, is the urban market growing, or the demand now clearly is coming from the rural India? That's where that's one pocket where prosperity for sure has kicked in.
Yeah, we are seeing higher growths in semi-urban, the small towns, as well as the rural markets. Perhaps we were invested ahead of what we've done in the large urban markets in this particular areas, and that's triggered the growth. But overall, we do see obviously a trickle-down effect happening, higher levels of prosperity and higher desire to consume.
So segmentally, Sunil, where do you see a higher market share? In the food segment or the hair oil segment or cosmetics?
I think we'll be able to maintain or improve our share in most categories. There were categories like, say, shampoos, where we had some share loss last year. I think much of it we should be able to regain this year. So overall, I don't think there'll be any dramatic movements in market share, but we should be able to improve upon shares in most of our categories.
So how exactly is Dabur India planning to differentiate now going forward? Reach, better products or innovation? I know you will say all three, but give me the inside strategy.
Well, there would be high level of innovation, there's no doubt about that. The reach part has been played out in terms of the exponential growth in reach, which we did last year and the early part of this year. So the increase in reach will be a little bit more incremental. And I think we will continue to invest heavily behind our brands. So that part which we started off around a year ago, that trajectory of investment will continue in the next year. I also don't think we will be entering new categories because we do have presence in a large number of categories, so we need to build upon those rather than to venture into new areas.
As per the latest, I looked at your promoter holding and it's quite scattered. But as per the new SEBI norm, are you in line with the 75% ownership?
Yes, it is. I think the ownership as of now is under 70%. It's around 69%, so it's well under the SEBI norms as far as my knowledge goes. But whatever are the norms, if they're reset, I think we will obviously adhere to those.
What is unique about FMCG companies or Indian FMCG companies is that they are cash plus, they never dilute. They only raise money when they acquire something. Are you confident that with your existing cash flow and with your strong expansion plan, you don't need to raise money, you don't need to visit the capital markets?
No, I don't think so. There's no need for us to visit the capital markets. If we need money, we can raise it through debt. We are highly underleveraged like many other companies. So I don't think there'll be any change as far as the current visibility goes in our capital structure.
Sunil, good chatting with you. Appreciate you taking the time out and joining us today on the show.